said a little of this at dinner, Michael, that I don't think it would have been everybody's choice in leaving this muckety-muck position at Treasury and having run, been in such a critical seat at a painful time for the financial industry, to then step back and write about no slack. And so just start us out by saying, why did you write that? Had it been percolating? What was your...
Yeah, so it's obviously it's an area I've been working in for a long time, and I had done a lot of the empirical research before going into the Treasury Department. So in some ways, it was a natural thing to return to. But I was really driven to finish it and to get the book out and to share it because, when you think about the financial crisis, obviously it had huge macroeconomic effects. It had huge and devastating effects for the financial sector. But really the thing that made it, I think, just brutal was what it did to families across the country. And household balance sheets were wiped out. People lost enormous amounts of their net worth. And people lost their jobs in the millions. We're still not recovering from that. People lost their hope. People lost their homes. And it really, I think, just crushed so many families in this country that it was really important to me to be able to get out and tell the stories of low-income households and their relationship to the financial system in a real way. And so the book is based on these interviews that I had done before the financial crisis. And I'm actually in the process now of integrating into the next version of the book a new chapter that includes follow-up surveys that were done in 2009 and then 2011. I had a subset of the interviews that I had conducted embedded in other instruments. So while I was at Treasury, there was a broader survey going on, and I included those elements. So for me, the book tells the story of no slack. And by that I mean many households, particularly low and moderate income households, have no wiggle room in their lives. So they have no emergency savings. They have very constrained or expensive access to credit. They have often no insurance or constrained access to insurance. And so the kinds of ways in which the financial sector can help empower us to ride out volatility in our income or in our expenses are often not available to low-income households. And so a very small change in their circumstances can really be devastating to them. So if people think about things like, and this is certainly the case in my study, people who get in a car accident. They don't have health insurance, they don't have auto insurance, they miss work, they get fired from their job, they lose their child care support, or whatever. It can be devastating. But even a less dramatic event can have a huge impact. So volatility in hours worked, which almost all low and moderate income people experience, makes a huge difference in their ability to eat at the end of the month, or may result in them taking out high-cost loans, payday loans, or other, or pawn-shop loans, or other expensive forms of credit. Again, something that doesn't rise to the level what seems like an emergency. It's just a change in, instead of getting, your normal 38 hours a week or 50 hours a week or whatever it is, you get knocked back because there's less demand. So that can be quite devastating. And that's really what drove me to write the book and to be interested in it and to work on measures to make their experiences less brutal.
Yeah. Does the they in the book, did you start to feel, having done some of the interviews before the crisis and then later, did you start to feel that the they is bigger? You know, in some ways, poverty, we talk about this a lot at Aspen, poverty actually, it seems quite hidden, and we don't use the word. I actually think no slack is really clever because it seems like we can all hit, you can be in the middle class precariously
Yeah,
and feel that. But
definitely.
did you start to feel like you were really telling a story of poverty or really telling a story that spread more to the middle of incomes?
You know, you have to be careful. So my empirical data is about low and moderate income households, and so I want to be careful to not go beyond the empirics with respect to that book. But I think the problems more generally in this country do affect many middle income households. Certainly experienced that when I was at Treasury and after. And many, you know, as we've been talking about for the last 2 days, many middle income households don't have the wherewithal to engage in what they need to do in their daily lives to feel financially secure, let alone take the next step of preparing for security in retirement.
Got it. Yeah.
So the retirement aspect for most families is very distant. So if they're not put into a plan automatically at work and they're not paying down a mortgage, they don't have anything. And I do think there is a little bit. There has historically been a little bit of a tendency in this savings world that many of us work in to focus, I think, too exclusively on the long-term retirement issue and not enough on daily financial security issues. Because to me, those are sort of prerequisite to thinking about the longer term. We need to, I think, help low, moderate, and middle income families achieve more financial stability in their daily lives, and then they can build to achieving financial stability for the future. And I think that in many ways this is not what needs to happen is not a great mystery. So everybody talks about financial education, but not much of it works. So can we focus when we're talking about financial education on very particularized interventions at the moment of choosing a financial product, rather than assuming that we're going to turn most of the public into people who would want to sit and listen to this conversation, which most people would not, I assure you.
I'm gonna pause you before you go any further, because I want to recognize that we are in quorum here. So thank you, and I want to pause and just bring everybody back into our morning session. America the Illiterate: How can we improve financial behavior? And I want to say that when we thought about this day, and you can sort of see a sweep to our thinking, maybe it isn't as clear, but from very macro issues to coming right into the household. And we want to end this Financial Security Summit on what's happening at the consumer tables and what's happening in the mindset of Americans. So both the first session that we're going to do today on improving financial behavior and the next one about the press and how to think about this are really about getting into our tables and our minds as the country. So we are really lucky to have Michael with us, to have Bob Friedman with us. You've seen Bob's bio. I just think the world would be a much shallower place without the Corporation for Enterprise Development, CFED, that he founded and conceived. And I'm so glad, Bob, you joined us this year. And Phil English. I didn't know if I could dare ask you to come back again. It seemed unfair to make you do your starring role twice, but you graciously accepted the invitation to come, and deeply appreciate it. And I really appreciate your role on this panel too. So this session really wants to look at how we're thinking about changing the behavior. We've had a lot of systems talk, and all three of our starters here, you all have ideas too, but have really been at this game and at how do we move people into the products that'll allow them to go up the ladder up the ladder to financial security. And Michael, you already started us off by saying there's a lot of folks scrambling before you get to any ladder. But it's the path to financial security. It's something most of us work on all through our lives. So I want to start with sort of a hopeful note. We ended last time's session on what are the challenges or obstacles. I want to start kind of on a hopeful note. And since you've been in a kind of catbird seat, both in the public realm and as a professor, I want to push you to say to us, give us a sense of what's the real frontier? What are some of the best developments you've really seen to affect financial behaviors? We have plenty of pessimism about Americans' ability to do anything, but give us a sense of what you've seen on the frontier.
Well, I think that we in the world we live in, you don't get perfect sets of outcomes, but I do think there's been enormous research in the last 30 years under what the rubric that is now known as behavioral economics, using insights from psychology to better understand human decision making. I think there's been enormous progress in understanding that our rational agent model was on which lots of policy has been made in the past was really quite incomplete. So the basic idea that individuals have a decision to make, they form their decision based on an understanding of the operative facts. They act on their decision that they've just made, and it leads to an outcome, is not really how most human decision making happens. In fact, it's not often clear what decision a particular consumer is thinking about when confronted with a financial choice, for sure. So it may be that that the omniscient financial provider or policymaker is thinking that individual is making a decision about which kind of mortgage to take. But really, they're not thinking about that. They're thinking about buying a pair of sunglasses or a car. They're making different decisions in their head, and this financial choice in front of them is really just a barrier before they can do the thing they want to do, pick out cabinets for their kitchen or whatever. I mean, it's not clear. And then obviously lots of research about the fact that once people make a decision, there are barriers to executing on that decision that seem trivial, may seem trivial in a rational actor model, but turn out to be quite significant in the real world. So again, I can't remember who was mentioning it. Maybe it was John yesterday. That those of us who have made commitments to go to the gym, pretty small things can keep you from the gym every single day. There's a wonderful photo that my friend Elder Shafir likes to show of there's a gym, and you have a series of steps to get up to the gym, and there is a line in front of the escalator to go to the gym. So understanding that actually, I think, helps us be much better at making financial products and at making financial policy. And so what I've tried to do in my book and in my work at the Treasury Department was to take some of these insights, combine them with an insight into particular market context, what are the incentives of firms, and to develop policies and products that are more useful. And we've been talking for the last couple of days about one very prominent example of that, which is automaticity, which is just absolutely critical for savings. And the reason it's critical for savings is because of these behavioral insights. If we had a model that was a rational actor model, we wouldn't need automaticity. We need automaticity because people are human. And so I think that's an important example. Another example of that on the regulatory side is the CARD Act in 2009, which used some behavioral insights to recognize, for example, that it was not possible really to achieve a good policy outcome by disclosing to people that their due date could change every month. So the Act actually took a pretty aggressive stance on saying that that was not permissible, or using what are called debiasing techniques to help people reframe the choice they have in front of them. So the minimum balance disclosures in the credit card statements now help people understand the consequences of only making the minimum payment.
Those are the ones that say, if you pay this, you will be paying for X number
17
of
years, yes.
So.
And pay X $1,000 more. And if you pay this slightly additional amount, you'll be able to pay off your balance in 3 years. So that those are the kinds of insights. And then I think that there's promise in using behavioral approaches to improve outcomes in financial product innovation too. So one of the areas that I've been doing some work on with others recently is the idea of a financial stability account. And the idea of a financial stability account is to develop a bank account, debit card only bank account, that automatically pays from the top of the incoming direct deposit some core bills. Then it sets aside into a separate bucket a small amount for savings, and then there's a bucket that's the residual, which is discretionary use for the individual. And the idea behind it is to help people who are close to the financial edge better manage their money and to build up emergency savings so that if they're hit with a problem, they're less likely to spiral out of control. So those are just a handful.
Those are good. So automaticity, the things that you saw enacted in the CARD Act, and this kind of innovative idea of a financial stability account, all deriving from the behavioral side. Mm-hmm. Before I let you off your hot seat, I want to come back to a topic that you raise in No Slack, which is about the behavior around unbanked products and choosing to be unbanked in the traditional sense, you know. And I want to come back to, you've given us, your book talks a little about this, but help us understand, what are some of the main reasons we still see, I don't know if it's fair to say, but the choice to be unbanked, and what, again, are some of the developments that have been out there, other than just preaching, to sort of bring people back into financial mainstream when it's a choice?
So first of all, for a hunk of people, it's not a choice. So it's not a choice either because they had a bank account in the past and they overdrew their account sufficiently that the bank closed it for them and they can't get another one. So they're in what's called the check system, which is a large reporting system for understanding the behaviors of bank customers. So those individuals are out of the system because they had a bad experience in the past, and banks don't want them back in. There's some banks that are now, have been for the last several years, experimenting with accounts that let people rebuild their transactional experience in a positive way, despite their check system encounter, and I think that's encouraging. A second big reason why individuals are unbanked is because the banking system, again, until quite recently, didn't really design products that were good for them. So having a checking account where it's easy to overdraft and you have expensive fees or very high minimum balances, it doesn't make sense for a low and moderate, didn't make sense for a low and moderate income person to have that kind of checking account. And so they didn't, or they did and they had a bad experience and they got out and they didn't want to come back. So on the product side, I think the financial sector can do a much better job, is starting to, but could do a much better job at providing financial products that meet the needs of low and moderate income
And
households.
you've started to see this?
And we've started to see it really. I mean, Bob will appreciate this basic problem. I've been talking about this stuff for a very long time. So you say the same thing over and over and over again. You hope that eventually,
It's true, yeah.
eventually
It will be so.
it gets done. And I really do think there has been a shift in the last couple of years, really maybe even 18 months, in terms of some very large institutions beginning to offer products that I think are safe and affordable for low-income families. Debit card only, no overdraft, no checking, low fees, bill payment. So really a basic account, but one that meets their basic needs to receive their income, to store it, and to spend it in a safe way and in a low-cost way. And I think that's promising and quite useful. So, the first part, past bad behavior and how to overcome that. The second part, getting the financial system to develop products and services that actually meet the needs of the customers that we're talking about. And I think a third important element in making progress on that is having good consumer protections that people don't have to have a law degree to understand. So, it shouldn't be the case that if I have a piece of plastic in my wallet, I have to wonder, is this a piece of plastic my employer gave me, or a piece of plastic the bank gave me, or something else, to understand whether or not it has lost and stolen card protection and how much that covers, and is it FDIC insured or not? Geez, I don't know. I mean, so if we can develop a consumer protection approach that is consumer friendly, and we now have the legal authority to make that happen in the marketplace because of the Dodd-Frank Act, I think that also will make a big difference for the unbanked.
You want to play favorites and say what's your favorite part of the CFPB? Favorite thing that would answer our title: improve financial outcomes, improve financial.
I think that let me answer conceptually rather than by section
Yes,
number.
by section. We don't
So
have to.
conceptually, the thing that I like about the CFPB's, the outcome we got in the Act, is its suppleness. So it's an agency that has the flexibility to take on problems as they arise in the market, as opposed to only looking backward to the last crisis. And in doing that, they have a range of tools. So it doesn't have to be only a kind of gotcha after the fact enforcement action. It can be supervision and guidance and being in the institutions in a meaningful way along the way, and they can recognize problems before they spin out of control. So for me, the most important aspect of the CFPB in terms of its ability to deliver consumer protection is that flexibility, that suppleness.
Love it. I love the vocab around here. We've gone from beautiful products to supple regulators. I love it. I'm going to let you off the hot seat for a moment, and I'm going to turn to Bob. And Bob, as I outed you before, it's been over 30 years that you've been devoted to this question of what will make families in America, all of us, able to really move up the ladder. So I'm going to push you on the same direction and say, in your mind, give us some hope. What's really top of your list as really best solutions to changing financial behavior, and in this case, helping families to save more?
Great. Well, first, I just have to thank you, Lisa, particularly for setting this table. And I know the bravery and dedication that's taken. And really just to say, again, how honored I feel and privileged to be able to be in this group. And I've had the opportunity to learn from a lot of you, but also to see what you've done. I am going to be very optimistic today. I will talk about child accounts, and I will talk about I will assert that they do change financial behavior. But I would prefer to parade under your title for the first session.
Nice.
Household savings, the key to macroeconomic growth, because I do feel very hopeful. And and fundamentally because I think there are a bunch of win-win-win strategies here that by enabling the vast majority of people to play in the marketplace successfully, we'll all be better. I was reflecting a lot on the discussion yesterday. I think it's kind of amazing that we can even conceive of retirement security given the kind of gaping asset disparities that Robert talked about starting off. But in a way, I think financial security may be too low a bar. I mean, just to survive a little above the poverty line when you're old, I think is not enough. I think we have to have higher aspirations for folks. I think we need to start early, and I think birth is not too soon. The other discussion I reflected on was the immigration discussion. And obviously, I think that we should confer citizenship as a matter of respect and dignity. But I think this $1 trillion bonus that the economy gets should say something about us and remind us what I think has made this country economically strong from the beginning, which is that we do give common people an opportunity to build their own lives and with it the economy. I do subscribe. I don't think you get the kind of disparities and gaps we have without a systemic cause. And I think you can see that. So I do think it's important to understand the importance of savings and assets, and not as something you get when you go to Walmart to buy something, and not as something that's just a sacrifice or just moving money through time, but as an economically active ingredient. If you're in debt and paying last month's and last year's bills, you're not feeling very good about yourself, and you're not thinking ahead. Having even a small amount of savings allows you the luxury of imagining a future better than the present and preparing and planning for that future. I love the lines from Michael Sheridan's Assets in the Poor. Income may feed people's stomachs, but assets change their heads, or that assets are hope in concrete form. I do think, and I'm really grateful to Lisa and Jean and Kilolo for this, that asset building, economic progress is a lifelong endeavor. That emergency savings, saving for college, for home ownership, for entrepreneurship, are not leakage. They are the lead that can get you to retirement security on your own. I also think, as Fred Goldberg always reminds me, the plumbing is crucial. You need to set up the system right. I have not seen any evidence that financial education without an actual account and actual money has much effect. On the other hand, if you have an account, folks in the American Dream demonstration for each hour of basic financial education or asset-specific financial education increased their savings by $1 to $2 a month. That may not sound like a whole lot per hour of education, up to 10 hours, and then it declined. So that brings me to child savings. And the notion that, the Billie Holiday notion, God bless the child that's got its own and can plan ahead. There was national legislation proposed on a bipartisan basis with the congressman on my left, with Senators Santorum and Corzine. It didn't go anywhere. but it's still an alive idea. It will be reintroduced. It will be reintroduced on different ways. I think we heard yesterday that Kevin, the states are acting as laboratories of democracy, but in the child account area, I think it's cities that are really acting as the laboratories. And the one I want to hold up to you, well, I guess first I want to talk about our favorite data discoveries of the last few years, which is based on the work of Willie Elliott, who found, looking at PSID data, that kids with a college savings account in their own name were 6 to 7 times more likely to attend college than those without, even though the amounts in those accounts was less than $500. In subsequent research this year, he found that as little as $1 in an account changes the expectation in a fundamental way and entrance, but the amount of money you have in that account affects your completion rates. So money does matter, but I think we need to appreciate both the psychological and economic leverage of savings and equity. Which brings me now to kindergarten to college. Starting this year, but it's led up for 3 years, every kid entering public kindergarten in San Francisco will get a college savings account in their own name. It is automatic. It is universal. The city was very clear. They didn't want to have or ask for ID numbers, which they don't, or citizenship. Every kid is covered. You can opt out. 2 kids have. There's a public seed deposit, $50 for every kid, an additional $50 for every kid eligible for free or reduced school lunch. There are private sector matches, a 1-to-1 match for the first $100 in savings, and another $100 bonus if you save at least $10 a month in the account for 6 months. There are numerous deposit options online. Tellers, Citibank has developed a special account for this. The withdrawals are restricted, but there are a wide variety. And essentially, you can't get the money out except when, at age 18 or later, you're ready to attend a variety of educational institutions. And financial education tied to the account is integrated within the K-12 curriculum. And each year now they're adding not a specific course, but in the math curriculum or with kindergarten kids, draw the college that you want to go to. 8,300 kids are now enrolled, and 4,800 will be enrolled in each successive year. 1,000 of the families have actually saved in the account and have added 300,000 in savings. The participating families, like the kids in the school system, 60% are eligible for free or reduced school lunch, and 60% of the savers are those families as well. So low-income families are saving it at the same rate. Now you may say 1,000 out of 8,300, is that 12% good? And it's compared to what? It is 4 times the rate of savings in 529 college savings plans. But I think the crucial piece is that everybody is in. Everybody is covered, and you may not wake up this year. Most of the families say, well, I'm going to do it. I just haven't quite gotten there yet. Next year, the year after, it will still be there. We could do this for, and then I guess the other piece, I was able to attend a conference last year, the Child and Youth Finance International. The goal of that is to bank 100 million kids around the world by 2015. I originally thought that was going to be in more than 100 countries. I thought that was going to be impossible. But as of last month, 102 countries came. Folks like the Union of Arab Banks, several national authorities, international authorities. The count is already at 18 million. There's tremendous excitement around the world on this. I think it is an idea whose time has come. Cleveland will roll out their kindergarten to college program this coming fall with not only public school but private and parochial school students, 14,000 kids a year on. I think there are another dozen jurisdictions. So let me close. For 34 years, I am kind of in a rut, but CFED and particularly our partners here and around the country, I think have proven with the most rigorous of research, that given a reasonable opportunity, low income and even very poor people will save, start businesses, go to college, buy and keep homes, create economic futures for themselves, their families, and ultimately the country. I believe that the greatest, the most significant, widely shared, sustainable increases in economic welfare in this country have come when we've invested in the common genius. Universal public education, the Homestead Acts, albeit with each of these, with land we stole from the Indians, but so the creation of the 30-year mortgage, fixed-rate mortgage by the federal government, again, with huge discrimination, but Trita Shanks figures 25% of American households can trace their wealth today to the Homestead Act. And then my favorite, the GI Bill. You served our country, we'll finance your business, college, home loans. I'd like to see a GI Bill for the 21st century, but based on savings and a savings incentive. I love Michael yesterday reminding me of universal savings accounts. I still think I love the refundable savers credit. For 1% of what we're spending annually in what I consider the asset tax expenditure budget, home mortgage deduction, preferential capital gains, pension fund exclusions, we could fund, a basic match or deposit for every man, woman, child in the country, including the bottom 60% who do not share in that system. We need a platform for that. I think the 401k retirement system comes best, particularly, I like that you could use it also, borrow from it for home, for college. I would like to add entrepreneurship in there, but if not that, then let's create a system of child accounts. I'd ask financial institutions, as I know John already is, to figure out products to serve this market. I still am reminded of APG and Bank of America handing out loans to people no one else would touch. I think we need accounts for everybody. And I think we could do this on a bipartisan basis. I think if the job addressing poverty in the 20th century was the creation of the safety net, then our calling now is to build the ladder. I've always loved the Langston Hughes poem, let America be America again, the America that never was, yet still must be.
How can you follow Langston Hughes? It's impossible. Thank you, Bob. Bob, just on a little note, I haven't heard you call for a GI Bill with a savings incentive. Is that the same thing as the child account, or are you ruminating on other thoughts?
I don't know. There are a lot of forms something could take.
Yeah.
I would like to start with all kids, but I don't want to miss people in middle age who are, it's going to take a lifetime to create opportunity. So I think some kind of simple automatic incentive and account.
Yeah. I think you reminded us about the incentive too. All right, I'm inspired again, as I always am. And last year we brought Treasurer Cisneros of San Francisco here to our summit. And not only did he inspire us, he basically said, help me. And this group came back around him. We organized a session in December in San Francisco, also a nice place to be in the winter. And, leaders, financial types came around to sort of help that city as it builds out a pretty powerful program. So it's great. And if folks haven't seen A Foot in the Door, it's a completely, it's on my Oscar list. It's a short documentary film, so on that thing. So I recommend it to you. I want to turn to Phil. And Phil, we've been longing for your Congress of the past. When it's just no secret. But when you were a member of the House Ways and Means Committee, you had jurisdiction over the very types of policies that Bob is talking about. And you saw the child counts legislation. You joined it, I think. And it's not like there weren't two parties with different views, but you really saw a bipartisan appeal to policies like this. Why? Let me push a little more. What's happened to matched savings? Why isn't this a policy that could have catch fire more around, particularly in traditional members of the Republican caucus who've always believed in assets?
Well, part of it has to do with some of the institutional dysfunction, but a major part of it also has to do with the rules in which we're operating, passing legislation. All of these are very good ideas that on paper have a nominal cost. Now, I'll offer you my view of why I don't care what kids' accounts cost. Now, this is an economic analysis from a non-economist. But when you give a kid $1,000 and they bank it, and you take that from revenue, you're nominally increasing the deficit by $1,000. But it doesn't matter because it goes into the pool of the savings. So from the standpoint of capital markets,
Yeah, I see.
It's self-financing. Now, that's not the rules we're supposed to use, but that's the reality of it. Things that increase the national savings actually go directly at some of the current concerns that Maya McGinnis has about how we finance our deficits. So it is really part of the solution. It has also, these are issues which have tended to get lost in the shuffle in the big battle between, tax reform writ large, fundamental tax reform with a rush towards simplification, and on the other hand, an attempt to close loopholes to generate revenue. These proposals don't do either of them. Mm-hmm. They actually do something that's far more fundamental. They have the potential, when wedded with grassroots support, to actually change the culture. I would argue, I agree with what Michael said about financial education for the most part. But I think that you can empower a movement to push toward broader savings if you create some of these instruments and have the will to do it. It is an issue which has lacked a champion because savings is not sexy. On the other hand, I would argue, and I'd like to give you an example in a minute, that building on experiences similar to what we've had in San Francisco with Cisneros, it is possible, I think, to build a grassroots effort on a community by community basis that actually builds the constituency for precisely this kind of initiative. The Cisneros initiative badly needs a federal reaction, a federal component to make it all work. The city of San Francisco and their bank partners ultimately are going to have a hard time when these bills come due. this is an appropriate place for federal program. I think auto IRAs, recognizing that they will have a limited but very tangible benefit, ought to be a piece of this solution. I think kids' accounts ought to be a piece of the solution, and you can attract support for both of those across the political spectrum. I think flexible tax-free savings accounts on providing tax-free accounts that are much more flexible will be seen by some as causing leakage. But if it also moves up the national savings rate, I think it, on its own merits, is worth doing. I would argue, and I haven't heard anyone bring this up, this was a bill of mine that I worked with the insurance industry on. Why not simply take the tax off of income generated by annuities that are annuitized at retirement? Why not have tax-free annuity? We were talking in one of the earlier sessions about how you attract people toward annuitization.
Oh, I see.
This, making them tax-free absolutely changes the equation. Everyone will jump on them, and a lot of competing products will say it's unfair. And frankly, I don't care. Because annuities provide enormous security. I love the idea of a refundable saver's credit. That hasn't caught fire because refundable credits, we hear, are too complicated, and they have high rates of they have supposedly high rates of fraud. We hear these arguments against EITC all the time, but you have to balance that against the actual benefit. And frankly, a saver's credit would be an odd thing to be all that fraudulent.
Right, it's sitting in the
So I'm not too worried about that. I think we also ought to, and I'll just put this on the table, have a comprehensive approach to repealing all of the biases against low-income savings and assets, whether it's in student aid, public assistance, or Social Security, and then you start to change the rules that encourages the culture to go in a different direction. If you have a few minutes toward the end, I'd like to talk about a specific thing that has happened in Erie, Pennsylvania, that I think shows how this could be a game changer in a big community, a small community, or even a very poor community.
Okay. Thank you for starting. I'm going to go soon to all of you, so if you've had something brewing, you can turn your card up. But let me just push the panel one more time. The behavioral change, is it products? Is it incentives? Where do we lean more? Michael, you started us off with it's the behavioralists, they've won the day. You have to build it into the
Well, I think
product,
they've won the
but
day
where?
on the empirics. It's different from winning the day.
Good point.
So but the question is sort of how do we change human
Yeah.
behavior?
Is it an incentive question, or is it a build it in?
I think it really depends on the particular both market context and set of biases or problems you're trying to overcome. So I don't think there's a one-size-fits-all answer. So, for example, defaults can be really useful in the retirement context in situations in which, by defaults I mean automaticity, getting people in automatically. In the retirement context, in circumstances in which the financial sector's interests are reasonably fully aligned with the individual's interests in the sense of both wanting to get more assets under management. In other contexts, it may be harder to rely only on a default if the market is pushing against the default. So if you're trying to get people automatically into a safer credit card product, but the industry would rather that people be in a less safe credit card product, having an automatic arrangement is not enough. You have to have strict rules of the game. And so that's why I think some of the initiative is around product automaticity, developing products that meet the needs of consumers. Some of the work that needs to get done is around consumer protection, making sure that there are clear rules of the road that protect consumers and that let the market compete within that basic framework. So you can have a beautiful product, but you have a beautiful product because you don't have to compete against somebody with a hidden ugly product. Right? You're competing against somebody with a safe product, and your product is safe and beautiful. That's the kind of competition I think we need. And then I do think there is this third component of financial education that can, on the margin, in particular contexts, if used well, help people better understand the particular choice they're about to face. So I really do think all three components, financial education, consumer protection, and products innovation, are all three critical to making progress. And do I agree?
With Bob's point that he's seen it work best or only when it's tied to the product.
I think it has to be tied to a particular financial choice immediately facing the individual.
Okay.
So if you have a 10-second pause between the education and the choice, you're already losing.
Bob, on the question of incentives or structures.
I think you need, excuse me, I think you need both. And I am grateful to, another thing I'm grateful to Michael for, along with Michael Schradden, is talking about, the kind of structures we need. I do think we need incentives, and incentives for savings and building assets. I mean, again, the 43% of American families right now are liquid asset poor. They can't get through 3 months if their major source of income is disrupted. And that's, of course, 2/3 for people of color. And then we have we're spending about $500 billion a year in savings and asset tax subsidies, which overwhelmingly go to the top 1%, 5%, and 20% and totally miss the people who need it and would use it at the bottom end. So I think we could do something for a fraction of that that would deal everybody in. And while I think we're all limited in our rationality, whenever I have trusted the capacity and the innovation and vision and commitment of low-income people, it's been rewarded. They do amazing things.
Excellent. Phil, you've given us an impassioned view of incentives as not even costing anything, which I love.
Well,
which is...
and sometimes the things that provide the incentive also don't cost anything. My example.
Yeah, please.
Erie, Pennsylvania is a city of about 100,000 people. It used to be, back in 1960, about 140,000. It is a Rust Belt community where the economy and opportunity has been in decline. It is a place which is incredibly ethnic diverse. On one hand, very welcoming, one of the top 5 destinations for political refugees in North America. On the other hand, we have a minority community which is proportionately smaller than in many urban settings, but has been particularly hard hit. And a study suggested about 25 years ago that minority children in Erie, Pennsylvania had the bleakest economic prospects in North America. And that's something we've been grappling with. And that brings us to my friend Joe, who's now more or less at retirement age. He's in his, I'd say, mid-60s. He has, over the years, gone from having nothing to being an insurance guy, having been a laborer, having been in the union movement, and having invested in property. And he has ended up, by understanding the dynamics of investment, he has had an extraordinary personal success story, which he'd be the last one to brag about. So for the last 6 or 7 years, Joe has been going out into our community and, contrary to more formal programs, has been very successful with financial education. He has what he calls his Thousandaires Club. And his objective is to get in that community, extended community, 1,000 kids to save $1,000. And what he has done basically is go out as an advocate of grassroots capitalism, go to high schools, go to churches, go to neighborhood watches, go wherever there are kids, and basically sit down with them and make a pitch. And he speaks their language, and he's very persuasive, and he pretty much finances this all out of his own pocket. Now, I sat down with him recently at a Starbucks just to understand exactly what he does. He handed me a flyer and a bag of coins. And I said, "What's this?" He had in it several pennies, several nickels, several foreign coins. He sits down with the kids, hands them each a bag and a flyer, and says, "This is yours. And I'm going to explain to you what it is and what you can do with it and what you can learn from it." And from there, he pitches to them the fundamentals of the game. You need to save money. If you're going to be in the game, you need to save. Savings is, for the money game, like dribbling is for basketball. I mean, you have to learn it, and you have to understand it, make it work. Second of all, money makes money. And one of the biggest challenges he finds is, particularly for low-income kids, getting across that money is a game, it's not a chore. He starts them out and says, "Okay, your first objective is to become hundredaires," and walks them through how to do it, basically by collecting pennies and nickels and dimes and being able to read them. He's actually, in a way that astounds me, he has taught a lot of inner city kids numismatics. What are the messages on the coins? Why are certain coins collectible and valuable? And how, if you go through enough coins, you're going to find some of those. You're going to be able to sell them. In the process, these kids develop respect for savings, and they also acquire the respect of their family. It's really quite extraordinary. He now has a large cohort, after having done this for about 7 years, of thousandaires. They have an inner city coin club where they meet once a month and they talk about individual coins. They tie it into history. Recently, for a Black History tour, he handed out several Booker T. Washington $50, vintage 1946, and explained why they were important. And as he has gone forward, he has deputized some people to take this very simple program out into their community groups and into their neighborhoods. How successful has he been? It's hard to measure this, but he offered me a number of case studies. One of them is Felicia. She joined 6 years ago, sixth generation welfare, an African American who, over the period of her involvement, saved $6,000. She's now 21 years old. She's graduated from Edinburgh University, and on graduation realized to pursue her internship, she needs to have a car, so she used her savings for a down payment on a car. She obviously understands how this works. There are others, kids who have saved $500-600 after a couple of years, and now their parents are coming to them for loans. It is an extraordinary thing. His basic pitch is, if you plant the seeds, you don't have to rigorously control the outcomes. Now, this is a perspective that's a grassroots perspective. There's no public funds being expended here. It's certainly something that could be seeded and could be encouraged, and probably is going on in a lot of other communities. I think it's fair to say this sort of thing is imbuing in the kids who are exposed to this message, or at least quite a few of them, an understanding of the disciplines the time horizons that are tied to savings, and also an understanding of how to use capitalism to bring themselves up. It's extraordinary to hear some of the stories he tells about the kids. And this is basically one guy in one mid-sized city who I think is doing an extraordinary job. That, to me, is, if we could measure it, I think we'd find it's more effective than some of the programmatic responses. It's probably not a substitute for it. If anything, this is an argument for one piece of the solution. If that makes sense.
Does make sense. Thank you for bringing your friend Joe to the table. We need to bring him here next year and maybe a few of his kids. I want to start the table out. And Jean, I saw yours first, and I'll come around. That's okay.
I would like to come out of the financial side, not just with broad discussion, great ideals, formal proposal. Before I say that, by the way, you have three of those kind of great articulate.
Thank you.
Very well said.
So my proposal at very base level is I think we need that every child in America somehow or another in some sort of interest rate. I'm dodging the issue of model. I'm dodging the issue of whether government contributes or not. I'm dodging the issue of whether the amount of money. And this goes back a little bit to how I sort of got into this children's side of the issue. Is Lisa may remember, and several others, is I was a very reluctant and slow recruit because, like Phil, I had worked a lot on tax policy, and the idea of one more credit, one more deduction, that was oversold for what it was going to do. I remember Bob Carey, we're going to put a $500 or $1,000 in a kid's account, and soon it was going to pay for college and their retirement, and all you had to do was compound the money at 10% real, and you could do fabulous things after 70 years of savings. And actually, I once did a study once just to take on that thesis, and I concluded that if you took the cost of the Louisiana Purchase and you compounded it at 6 or 7 or 8% real for about 200 years, if the French had saved it, they could all retire now and they'd never have to work. So we really made a bad deal.
They did anyway.
So that's not how I got converted. What I got converted is partly when I went to Britain and I saw with their child account is what I saw that $500 doing is setting up an infrastructure. And the basic thing that I saw it doing was corralling the financial institutions. They couldn't dodge it. People had this $500, now partly because it was more universal, so they had to appease their clients, which is across the board, low income, middle, and high income. Okay, you got $500, what are you going to do with it? I go to my financial institution. And so it corralled the financial institutions to come on board because you and I, everybody here knows that even $1,000 or a $2,000 account in most models costs these institutions money, right? It has to be a loss leader. But there's movements that makes it a little cheaper, the debit card and other proposals, so on and so forth. So I became a convert that if we could get kids in these accounts, that is, and several of you said this in different ways, that's probably the best financial education. It's almost better, part of that comes from your experiment, I think, too, Bob, some of your experiments. It's probably even better than all the attempts to give them formal financial education. They're learning by doing. They're sitting there. They're seeing this compound interest. And then I come at it also because I'm chair of a community foundation in Alexandria. And I'm actually a little envious of my friends. I have a good friend who runs the Grable Foundation in Pittsburgh. Pittsburgh has this model that they're going to be the best city on earth to raise a child. And I want to adopt that model for Alexandria. And I want to have things like all our children in an account. And, and you run the numbers. The $500 you wanted from the federal government for a child savings account, multiply it up. I think that cost $2 or $3 billion? $2 billion a year, yeah. So suppose it's $100. Well, now we're down to, I'm not saying that's the right number, we're down to $400 million a year. That's money that's achievable in the private sector and not just the public sector. And I'd like to be able to I'd really like to be able to go to the financial institutions in Alexandria as his chair and say, darn it, these other communities are doing something. We could do it. Let's get these kids in an interest-bearing account. And by the way, Wachovia's doing it, and whatever, the other banks in our area are doing it. Do you want to be left out? Which is what happened in this British model. And so I'm thinking we actually need a campaign that would literally, and hopefully we'd get some financial institutions on board on this, that we would have a model that we're going to try to have every kid in a savings account. And we could actually, it's not the ideal solution, community by community, fight for it. And then build on top of it, then build the extra, if it's the city contribution, or as Phil said, the ideal model is really to go to a more uniform federal type of create some uniformity. But let's not start off with having to say we got to get the $500 from the federal government, or even the money from the governments, although they might get crowded to it. Let's actually have a campaign that every kid deserves to be in an interest-bearing account. I think it would appeal so, at that level, who's gonna deny that it's not a good thing to have? And we could come out of this summit and say, we agreed that was a campaign. That's one thing, that's one small step, but one additional step we could really make a movement for. So that's my
Great.
That's my proposal, and I'm actually very interested to know how the financial institutions at this table would react, because I'm asking them to take a loss to get behind this type of movement.
So I'm going to hold that proposal from the delegate from the Urban Institute right on the floor, and as people ask other questions, give Gene a reaction to. It's provocative, and thank you. I'm going to come to Rhett.
Well, if anything's come out of this summit, it's that Bob and I are soulmates.
It's so true.
One of the things I thought Bob said that was important, and I was hoping you could expand on a little bit, and I'd be interested in the rest of the panels, is you talked about how investing in a home isn't leakage, but I think the part that you also talked about was potentially using some of that for entrepreneurship. And so I'm wondering if you can expand a little bit upon why you feel that way and what you've learned through CFED, and then I'm wondering, whether the other panelists agree or disagree.
I started CFED, Enterprise is our middle name, and the first thing I thought was, at the very least, we owed folks a chance, if they couldn't find a job, to create one for themselves. And we started with the self-employment investment demonstration with welfare moms, and just provided the opportunity. And indeed, they created businesses. I think 2 million new people become self-employed each year. I think out of that cauldron grows larger businesses. But when you're starting a business, you're using personal savings of friends, family, and associates. And I do think the results of the Great Recession are that that's been removed. I also, I think that, the EITC actually supports 4 million self-employed, 2 million of them, and that's their only source of income. Health coverage has been a major barrier. It was identified at one of our Assets Learning Conference as the major barrier, and I saw recently that just having health coverage is likely to produce another 1.6 million self-employed next year. So I think opening this up, demystifying it, making sure that people understand that entrepreneurship is not just for the wealthy and not just for venture capitalists, but for an outgrowth of our basic system. And it's the way you'll be able to afford some of those other things.
And Rhett,
Thank you.
since you were the first to respond after Gene, do you want to give him a reaction to his campaign idea? No reaction. The delegate abstains for now, votes present. All right, I'm going to come to John, and then I'm coming to you, Josh.
A couple thoughts, and first of all, I do want to start off.
By the way, John, you're one of the people who instigated me here, so you're going to have to take some blame.
I'm happy to take all the blame. It feels just like home. We have a lot of experience with child accounts. We offer 2 children's accounts today. We offer what we term a money account, which is a debit card only equivalent to sort of a checking account. It's no fees. Incredible safety and guardrails around what children and young adults can do with that account. And we also offer a kid savings account, which can be linked to that money account, pays a reasonable little rate of interest, shows the miracle of compound interest, and again, free and very sort of friendly terms. Moreover, we actually market those accounts, and we not only market them, but we actually pay incentives on them periodically. We don't do it every day, but as part of the marketing campaigns. And so I believe the last campaign we did was in either account, if you opened it, we would match your first $25 of savings going into it. So if you opened both accounts, by the way, you could actually get us to match up to $50 of savings. And in fact, we had some very enterprising folks who understood that quickly and went ahead and did it. I've actually purposely not asked for the economics on the account, but we're delighted to do it all day long. And in fact, we actually view it as being core to our brand. We view it as core to our customer positioning, and quite frankly, we view it as a sort of a great kind of a great training ground for the customers that we want to cultivate. But if I take a step back from that, I will tell you the results have been disappointing. And I don't have the exact numbers with me, but we don't actually sell a lot of these accounts. And, if I kind of think about that in the lens of our broader direct banking franchise, and just so everyone has the numbers, our direct bank serves predominantly savings-oriented customers. We have about $80 billion of those savings-oriented balances in our account, so it's not a small endeavor. It's a little bit over 8 million customers. And if you look at the distribution and the mean of the balances, the mean of the balances is squarely in Middle America. And the distribution of the balances shows that there are, in fact, savers in that franchise that are across the economic continuum, as best as we can extrapolate from the data we have. And I spend every week listening to calls from those customers. And what is really interesting is, by and large, and there's exceptions, these folks are wired differently. Savings is not easy for any customer, right? Everyone has something they would rather spend the money on. In some cases, it's much more basic and human needs. In other cases, it's more frivolous and sort of discretionary. But everyone would rather spend the money. And what is really interesting when you talk to these folks is, there is a palpable cultural, attitudinal view of savings, which is just different. And I can recall in the last month talking to people who are saving $5 a month, and I can remember talking to people who are saving $500 or $5,000 a month, and all of them have the same kind of cultural, palpable, damn it, going to figure out a way to stick to my savings goals and to make this work. And so I love the notion of supporting this through all the things we've talked about, auto enrollment, sponsorships of plans. I love it. But I want to really seize on this notion. I think we not only need a campaign, but I think if we're really going to be serious about this, we have to start to figure out how to change the cultural orientation between consumption and savings. And we have to figure out how to get more people to go through, and I don't know what cultural transformation each of these folks individually went through, but we need to figure out how to mint more savings converts. Because I really am a believer that people of any level can do some good here. And once again, I'm certainly not suggesting that for low-income people it's easy to save, but I think people of any income level can do some good here. I think a few of the panelists have said that over the last couple of days. But I'm also a big believer that absent that cultural transformation, even folks who are very able to save do not. And I think if we're not going to sort of confront that reality, in addition to the other things, and once again, I'm not taking anything away from them, but if we're not going to confront that cultural reality, I actually don't think we're going to make material savings here or progress here on really creating a more savings-oriented sort of culture out there.
Wow. Panel, I know you're dying to comment, but keep it short because I'm going to get these other things in, and we're at that home stretch of the last 10 minutes here. Phil, reaction, and then Mike.
I agree 100%, and I guess, the thing that we need to go deep on is packaging some of the incentives with an actual movement. Because I think this is going to take a cultural change. I think it's going to take a cultural renewal. We are coming at a time when people have largely forgotten the lessons of the Great Depression. This morning, some of you may have seen consumer debt hit an all-time high. So we're back to where we were back in 2008. That's a disaster. And although savings is up slightly on the margins, we're not where we need to be. And, I think Weber had it right that there is an ethos to capitalism. And I think that is ultimately fed by the disciplines associated by saving.
Wow. Wow.
I'm not going to be as deep, but I will say I like Gene's idea, and just linking to Phil's friend Joe, when just in our own household we opened accounts with our kids, when they were quite young, and one of the things we did with them is I have this annoying habit of dropping my change when I come into the house in various spots that are in the way of my wife and others. So what we did is our kids, we said to our kids, you collect all this annoying bits of change, the pennies and things that Dad leaves around, and put them in little rolls, and you bring them down to the bank, which in our case is 3 blocks from our house, and make the deposit, and that's your money now. And they could see, wow, if you collect enough of Dad's annoying change, you get real, you can get some real savings. And it started them thinking about putting money in the bank and saving it for later. And now they save money, and they go down to the bank and they deposit it.
It's really, it's the powerful. Yeah. And Bob, did you want to associate yourself with Gene's remarks?
I'd just like to associate myself with both.
Thank you.
And thank you.
Capital One. Josh, and then I might just force everybody to talk quickly because we are pushing on.
You talked about the issue of behavioral economics and that change versus incentives. And I think that is, and that personally, I think that's the right debate. I think organizational change, if it's possible, is more powerful than individual education or individual incentives. And so I think the challenge for you all to think about is, after a generation of trying to make a tax code which is complicated, which offers incentives, et cetera, and which does not work for these folks, provides an incentive to which they do not respond, whether it is worth putting your energy into continuing to try to perfect that system, or whether your energy is better served by, call them regulatory, or excuse me, automatic institutional changes like automatic enrollment in savings plans, et cetera. Just question to think about. Second question to think about is, we, in the retirement side, we all admit and all note that we don't, that this is not a great week to expect the Congress of the United States to do very much. And my question is, does that advice also apply in this effort? In other words, rather than trying, even if you think that savings incentives are the right thing to push, at this particular era, would you be better off letting the 1,000 flowers bloom by implementing Gene's idea at a state or something like that? Just a question.
Actually, 2 questions, because I
Just-
think
sorry,
you
just 2
did
questions, sorry.
tax code versus some sort of automated private system, or Congress versus some sort of private system.
Well, I think the regulatory environment matters a lot, and you got to get that right, both for the level playing field and lack of races to the bottom that I was talking about before, and also because you can make a huge difference with relatively simple tools like automatic enrollment. So I think that's absolutely critical. In terms of, and I agree also more important than the tax code in terms of actually making a difference to the people that we're talking about. In terms of the 1,000 flowers versus the Congress, I think you have to do both. I think that continuing to hammer with a good idea in the national space is important, and you never know when you're going to get this little political opening. And you need to have built the ground, done the groundwork, built the support for it, had the intellectual work done, and you need to have been hammering on it for many years. And then one day you'll discover through some magic that the Congress is willing to pass something. And otherwise, if you've only been doing this, the stuff Dean was talking about, which I think is terrific, then you will not have, prepared the ground properly for that.
Any other reactions?
I'm not sure that it's either or on either of your questions. I mean, I think incentives are part of the package, but I do agree. And I also, like a lot of things, I think I know less now than I used to. I'm not sure exactly how to build this system. So I think having 1,000 flowers, but also the potential of having some federal incentive. And the tax system, despite its current distortions, is at least touches lots of people lightly. So I maybe that's the way. If there's some other way, I'm open to that too.
Phil?
Very briefly, all the right questions. I agree you have to encourage all of it. I believe the tax code is going to face serious change because in areas other than in our area of concern, it is so badly broken. It's now a drag on our competitiveness, and I think it's honestly reaching a crisis where there will be an opportunity to include some things that could be framed as part of an agenda that appeals to both the right and the left at the appropriate time. I also believe that the initiative at the federal level is going to have to be small at first. So rather than for practical reasons, rather than giving every kid $1,000, which, by the way, I support what Gene is proposing, where we may end up is something like an allocable limited credit that can be apportioned by Treasury or even apportioned to states, and they can apportion it to communities to go in and to begin to fund these sort of initiatives at the local level in those communities that are organized and have brought together their financial institutions and their local leaders to support the effort, and also brought private money to the table.
Really good. All right, last two. It's going to be Kevin and then David.
Bob, just a couple technical questions with regards to the city and county of San Francisco. Mechanically, how did it work? Is it means tested? Is the city itself ponying up the money, or are they working with banks, financial institutions to help a partial amount? I know in California we have approximately about 510,000 births a year, and we have approximately 3.2 million children 5 years and under. So I kind of multiply that times $500, and that's like 1.4 billion dollars. And I remember that our president pro tem, Darrell Steinberg, really just pro-child, a great man, salt of the earth, and a Republican, Bob Dutton, I believe. They actually got together to work on this issue. Unfortunately, it was during the economic crisis throughout the country, but in California it was in 2008. Interestingly, a lot of folks, I remember, I was just getting there. I remember a lot of folks were kind of like lampooning them. They were just kind of like, guys got to be joking, And I remember it was really shrill. It was really pernicious. A lot of the columnists and editorial pages, it was mean-spirited, and it was unfortunate, but I'm happy to see this concept and this bipartisanship, And I love this idea of this child savings account. Just how does it work mechanically in San Francisco?
Well, I'd love to talk for a long time with you about all of those issues. I mean, the first point was it was every kid in. You know, it was universal, again, opt out. But they thought it was very important that it be everyone, no questions asked. The other thing that happened is, of course, it was Gavin Newsom who first advanced it at $500 an account. We couldn't get it going. And so the treasurer, who's good with numbers, said, well, if we can't afford $500 an account, why don't we do it for $50? And again, I think you can scale it down and you get some activity, but you provide a structure, everybody in there. I think for a long time, child accounts were a solution without a problem. People didn't know quite what they were for. I think now it's becoming a little clearer in terms of access to college. You know, I remember meeting Michael Lomax at UNCF, and he said, we're the second largest scholarship provider next to the federal government, but we're coming in too late. We're coming in, you know, thousands of dollars short. And most importantly, kids and their parents have no skin in the game. They don't understand. And by 18, if that's when your decision is made, it's too late to go on. So, and then I do think just we're beginning to understand better what the dynamics of savings are. But again, I don't think most people do.
And I hope you do find each other for more of the technical. What I also recall about the San Francisco move from 500 to 50, they took it from being an investment account to being a simple bank account. It took out all the reasons you would want it to be a larger than 500. And I think the college use did protect the lampooning. You know, people are going to just squander this funds, but I think we need some more counseling from Lori and her colleagues about how to position this. And the British example that came up earlier really did have a different experience of being deeply, you know, landing surprisingly. You know, all of a sudden everybody got vouchers to go off but accounts. But
can I just add one short thing, which is Secretary Duncan came out a few weeks ago to see the program, and some of the parents spoke, and they said, you know, it's changed the discussion around our dinner table. Yeah, I mean, one of the other problems was too far out college, but it really does change current
thinking. Yeah. David, last word, last question.
I will be very brief and just make a couple of very quick points. First off, just to connect various elements here, as I recall, both the Santorum bill and going back to Bob Kerry's KidSave account in 2000 had both a savings element to it and also a retirement element to it. So essentially, these are all parts of the same discussion, and we're all working in the same direction here. Second is that they have to be structured very carefully. The reason the UK experiment ended was that the Liberal Democratic Party criticized them because money was going to upper income kids. And that's a matter of messaging and maybe a matter of structure there. I mean, but I still agree with the whole idea of universal. And last but not least, I made a point yesterday about the difference between financial literacy and financial expertise. And I don't believe that we can educate someone into being a sophisticated investor, not the least of which they're not going to be interested in listening to a session like this. However, the part of the San Francisco experiment or experience, which includes the schools element, is absolutely crucial, because that is where we build, in addition to the homes, but that is where we build the savings culture that John referred to. And I wish he hadn't a branch in the Eastern Panhandle, because I want my daughter to have one of those accounts.
John hasn't left the room yet. he might be able to hook you up. I'm going to be over there too. And I forgot my promise to Jean. So Kevin and David, you asked questions, but do you want to react to Jean's call for campaign? Are you in? You're up. You're up. And 2 thumbs up. Jean, I want to thank you for putting a bold idea on the table. We had said yesterday, let's be bold. I don't know how to run a national campaign. I know how to run this campaign, but I think you've tweaked us and you've pushed us, and I thank all of you who took a risk. Jean, you commended us for finding 3 of the most powerful voices, and I totally agree. I've been doing discussions on behavior and savings and kids and change for pushing over 20 years, and I'm really thankful that the 3 of you joined me this morning and that all of you are here. So please, a round of applause, and we are on a break.